Ladies and gentlemen, people around the world, global investors, the financial system is sending a signal that cannot be ignored. Gold and silver are not rising by accident. They are moving because pressure is building across the entire global economy. Inflation is no longer a temporary phenomenon. CPI levels remain elevated, purchasing power is shrinking, and currencies are losing strength in real terms. This is not a market fluctuation. This is structural stress. Households feel it at the grocery store, businesses feel it in operating costs, and governments feel it in debt servicing. When money loses value, history shows one consistent response: capital searches for protection. Gold and silver are not speculative assets in this environment. They are financial insurance. They are trust assets. They are monetary metals that have survived every currency system collapse in human history. While paper currencies are created through policy and debt, gold and silver exist outside political systems. That difference matters when confidence begins to weaken. Across developed economies and emerging markets alike, purchasing power is eroding faster than income growth. Wage growth cannot keep up with inflation pressure. Cost of living increases are becoming permanent, not cyclical. This creates a psychological shift in investor behavior. People stop thinking about profit first and start thinking about protection first. Central banks have raised interest rates to control inflation, but the consequences are visible. Higher rates increase debt servicing costs. Governments are carrying historic levels of debt. Corporations are refinancing at higher costs. Households are facing tighter credit conditions. Economic growth slows while financial pressure increases. This is the definition of systemic strain. When interest rates rise in a debt-saturated system, the pressure does not disappear. It transfers. It moves into currencies, bonds, housing, and liquidity markets. Capital becomes more cautious. Risk appetite declines. Safe haven demand increases. Gold responds first because it represents monetary stability. It is not tied to corporate earnings, consumer demand, or industrial cycles. It responds to confidence. When trust in financial systems weakens, gold strengthens. Silver follows because it sits at the intersection of money and industry. It is both a monetary metal and an industrial necessity. That dual role creates leverage in times of economic transition. Industrial demand continues while monetary demand rises. This creates structural pressure on supply. Silver markets are smaller, thinner, and more volatile than gold, which makes price movements sharper and faster when capital flows increase. Global investors are watching the same signals. Currency devaluation is not limited to one country. It is happening across multiple economies through monetary expansion, fiscal pressure, and debt monetization. Real value is being diluted. Confidence in long-term currency stability is weakening. Capital always moves away from instability and toward perceived safety. This is not fear-driven behavior. It is rational capital preservation. Institutions, funds, corporations, and long-term investors are reallocating quietly, strategically, and methodically. The psychology of markets is changing. This is no longer about chasing growth. It is about surviving instability. When uncertainty rises, risk tolerance falls. When volatility increases, safety becomes valuable. When trust weakens, tangible assets gain importance. Gold and silver are not dependent on digital systems, policy decisions, or political cycles. They exist outside financial engineering. That independence creates demand when confidence erodes. Inflation does not need to accelerate to remain dangerous. Persistent inflation is enough to destroy purchasing power over time. Even moderate CPI levels, when sustained, reshape economic behavior. People save differently, invest differently, spend differently, institutions rebalance portfolios, governments adjust policies, corporations restructure operations. The entire economic ecosystem adapts. In that adaptation, capital flows shift direction. Debt pressure amplifies everything. High debt combined with rising rates creates fragility. Fragile systems seek stability. Stability is not found in volatility assets during uncertainty. It is found in assets that hold value across cycles. Gold and silver have fulfilled that role for thousands of years, not because of tradition, but because of function. They store value without counterparty risk. They require no trust in institutions. They require no belief in policy stability. They simply exist. Global markets are not calm beneath the surface. Volatility is being compressed, not eliminated. Liquidity conditions are tightening. Growth projections are weakening. Consumer confidence is fragile. Investor sentiment is cautious. Capital is defensive. These are not signals of optimism. They are signals of repositioning. Repositioning always happens before repricing. When capital moves, it moves quietly first. The headlines come later. The price action comes later. The public awareness comes last. The early phase is accumulation, not euphoria. That is the phase markets are entering now. Not panic, not mania. Strategic movement, structural reallocation. Long-term positioning. Gold and silver are not exploding because of hype. They are responding to macroeconomic reality. Inflation pressure, currency devaluation, debt expansion, monetary policy stress, and global uncertainty are converging into a single financial environment. That convergence is what creates a perfect storm. Not one factor, but many forces moving in the same direction at the same time. This is not about predicting collapse. It is about recognizing pressure. It is about understanding that systems under strain behave differently. Markets under stress price risk differently. Capital under pressure seeks safety differently. Investors under uncertainty think differently. People around the world are entering a new mindset. Not growth first, but protection first. Not speculation first, but preservation first. Not risk first, but resilience first. That shift is subtle, but powerful. And when mindset changes at a global level, markets follow. Gold and silver are not just assets in this environment. They are signals, signals of fear, signals of awareness, signals of adaptation, signals of preparation, signals that the financial system is entering a new phase where stability becomes more valuable than speed and security becomes more valuable than growth. The perfect storm is not noise, it is structure. It is pressure building across inflation, currencies, debt, policy, psychology, and capital movement, all converging into one reality. And in that reality, gold and silver do what they have always done when systems are tested. They rise, not because of speculation, but because of necessity. Global investors understand one fundamental truth. Markets do not move because of emotion alone. They move because of structure. Structure is built from policy, pressure, capital flow, and confidence. Right now, that structure is changing. The global financial system is being reshaped by forces that cannot be reversed quickly. Inflation has altered cost structures permanently. Interest rate policies have shifted debt dynamics permanently. Currency dilution has changed value perception permanently. These are not temporary cycles. They are long-term transformations. When currencies lose purchasing power, wealth preservation becomes the priority. Not growth, not yield, not speculation, preservation. Capital does not seek the highest return when uncertainty rises. It seeks the lowest risk of loss. This is why safe haven assets gain relevance in every period of systemic stress. Gold has always been the anchor. Silver becomes the accelerator. Together, they form a monetary defense mechanism against instability. Central banks face a structural trap. Raising rates controls inflation but increases debt pressure. Lowering rates reduces debt pressure but fuels inflation. Expanding liquidity supports growth but weakens currencies. Tightening liquidity strengthens currencies but slows economies. There is no perfect solution. Every decision transfers risk rather than removes it. This creates a cycle of instability management, not stability creation. Markets sense this imbalance. Investors sense it. Institutions sense it. This is why capital flows are changing direction. Not suddenly, not violently, but consistently. Long-term capital is repositioning. Sovereign reserves are diversifying. Institutional portfolios are adjusting. Corporate balance sheets are reallocating. Wealth preservation strategies are shifting. These movements do not make headlines immediately, but they reshape markets quietly. Silver plays a unique role in this environment. It is not just a store of value, it is an industrial backbone. Energy systems, technology infrastructure, medical equipment, electronics, and modern manufacturing all depend on silver. That creates a dual demand structure, economic demand and monetary demand. When both rise simultaneously, supply pressure intensifies. Production cannot scale instantly. Mining cycles take years. Infrastructure takes decades. Demand shifts faster than supply can respond. This creates imbalance, and imbalance creates price movement. Gold represents trust. Silver represents leverage. Gold stabilizes portfolios. Silver amplifies market reactions. This is why silver historically moves faster, sharper, and more aggressively during macroeconomic transitions. It is not speculation. It is structural sensitivity. When capital flows increase, thin markets react first. Investor psychology is evolving. Risk tolerance is declining. Time horizons are lengthening. Short-term thinking is being replaced by defensive strategy. Wealth preservation is replacing wealth expansion. Stability is replacing speed. Security is replacing speculation. This psychological shift is powerful because it reshapes capital allocation models. Money no longer chases growth blindly. It evaluates risk first. Emerging markets feel this pressure differently, but more intensely. Currency volatility hits harder. Inflation impacts living standards faster. Debt burdens grow heavier. Capital outflows destabilize financial systems. Developed economies feel pressure through slower growth, rising costs, and policy constraints. Different symptoms, same disease, systemic imbalance. The global economy is no longer synchronized. Growth rates diverge. Currency stability diverges. Policy effectiveness diverges. Financial resilience diverges. This fragmentation creates volatility across borders. Capital responds by seeking universal assets, assets that do not depend on national policy or political stability. Gold and silver fulfill that role. Safe haven demand is not driven by fear alone. It is driven by logic. When systems become complex, simplicity becomes valuable. When financial instruments become layered, tangible assets become attractive. When trust becomes uncertain, independence becomes power. Gold and silver offer simplicity, tangibility, and independence in a complex financial world. Debt expansion is the silent accelerator of this shift. Global debt levels require continuous liquidity support. Continuous liquidity weakens currencies. Weakened currencies increase inflation pressure. Inflation pressure increases social stress. Social stress increases political instability. Political instability increases market volatility. Volatility increases demand for stability assets. The cycle feeds itself. This is not collapse. It is transformation. Systems do not break overnight. They evolve under pressure. Structures bend before they break. Markets adapt before they fail. Capital moves before crises become visible. The perfect storm is not an explosion. It is a convergence. Convergence of inflation, debt, policy, psychology, and capital flow into one financial reality. Gold and silver are not reacting to one event. They are reacting to an environment defined by uncertainty, fragility, and adaptation. This is why their movement feels different. It is not speculative, it is not hype-driven, it is not media-driven, it is macro-driven. The world is entering a phase where financial systems are being stress-tested by reality, not theory. Models are being tested by pressure. Projections are being tested by unpredictability. Policies are being tested by consequence. Markets respond to reality, not intention. People across continents are experiencing the same core emotion, uncertainty. Not panic, not collapse, uncertainty. Uncertainty changes behavior. It changes consumption. It changes saving. It changes investing. It changes trust, and when trust shifts, capital follows. Gold and silver are not the cause of this shift. They are the reflection of it. They are mirrors of systemic stress. Indicators of confidence, barometers of stability, signals of adaptation. The perfect storm is not dramatic because of noise. It is powerful because of alignment. Inflation aligns with debt pressure. Debt pressure aligns with policy limitation. Policy limitation aligns with currency dilution. Currency dilution aligns with capital migration. Capital migration aligns with safe haven demand. Every force moves in the same direction. Markets do not ignore alignment. Capital does not ignore convergence. History does not ignore structure. This is how long-term trends are born, not through chaos, but through consistency. Gold and silver stand at the center of that consistency, not as speculative assets, not as trend assets, but as structural assets. Assets that respond to pressure, not hype. Assets that respond to risk, not emotion. Assets that respond to reality, not narrative. The global economy is changing shape. The rules are not disappearing, they are being rewritten. And when rules change, the assets that protect value become more important than the assets that promise growth. Stability becomes the new profit. Preservation becomes the new strategy. Resilience becomes the new advantage. And in that world, gold and silver are not optional. They are fundamental. People around the world are standing at the edge of a new financial mindset. Not a crash mindset, not a panic mindset, a survival mindset, a resilience mindset, a long-term mindset. The kind of mindset that emerges when systems feel fragile and the future feels uncertain. History shows that when societies reach this psychological stage, Markets change behavior, not just prices. Capital begins to think generationally, not quarterly. Investors begin to think structurally, not tactically. Wealth begins to think defensively, not aggressively. The question shifts from how much can I make to how much can I protect? This is the most powerful transformation in any financial cycle because it changes the purpose of money itself. Money stops being a tool for growth and becomes a tool for security. Gold and silver sit at the core of that transformation because they are not built on promises. They are not built on projections. They are not built on policy stability. They are not built on institutional trust. They are built on scarcity, physical existence, and historical function. In every era of financial uncertainty, societies return to the same foundations. Not because of nostalgia, but because of reliability. The global economy is entering a phase where fragility is becoming visible. Supply chains are sensitive, energy systems are vulnerable. Financial systems are interconnected, debt systems are stretched. Policy systems are constrained. When complexity rises, resilience becomes rare, and rare things become valuable. Investor psychology is no longer driven by optimism alone. It is driven by caution, awareness, and adaptation. People are not expecting collapse, but they are preparing for instability. They are not predicting disaster, but they are hedging against disorder. They are not abandoning markets, but they are redefining safety. Gold becomes the anchor in that environment. It represents continuity. It represents permanence. It represents stability across generations, borders, and systems. Silver becomes the dynamic force. It represents transition. It represents transformation. It represents the bridge between old monetary systems and new economic structures. Together, they represent balance between preservation and progress. Capital movement is no longer random. It is intentional. It is strategic. It is patient. Long-term positioning replaces short-term speculation. Structural allocation replaces emotional trading. Defensive portfolios replace aggressive exposure. This is how mature financial cycles behave when uncertainty dominates growth. The world is not entering darkness. It is entering recalibration. Systems recalibrate when pressure exceeds tolerance. Markets recalibrate when risk exceeds reward. Societies recalibrate when stability feels fragile. Recalibration does not destroy systems, it reshapes them. The perfect storm is not destruction, it is transformation under pressure. It is the convergence of forces that force change. Inflation forces value awareness, debt forces risk awareness, currency dilution forces trust awareness, policy limitation forces structural awareness. Together they reshape financial behavior at a global scale. Gold and silver do not create this transformation. They reveal it, they absorb it, they reflect it. They become the instruments through which capital expresses fear, caution, protection, and resilience. The most dangerous mistake in any financial era is misunderstanding the phase of the cycle. Late cycles look like opportunity. Early cycles look like noise. Transitional cycles look like confusion. But structural cycles always look like uncertainty. And uncertainty is exactly what defines this moment. Markets are not collapsing, they are adapting. Capital is not fleeing, it is repositioning. Investors are not panicking, they are preparing. Systems are not breaking, they are bending. And history shows that when systems bend, the assets that survive are the ones that do not depend on the system itself. Gold and silver exist outside dependency. They do not require trust in policy. They do not require trust in institutions. They do not require trust in stability. They require only belief in value itself. That belief is returning, quietly, gradually, strategically, across borders, across cultures, across markets, across generations. This is why the movement feels different. It feels calm, not chaotic. It feels steady, not explosive. It feels deliberate, not emotional, because it is not driven by fear. It is driven by awareness. The perfect storm is not loud. It is silent. It builds slowly. It forms quietly. It strengthens structurally. And when it becomes visible, it is already mature. Gold and silver are not reacting to headlines. They are responding to reality, a reality where uncertainty is permanent, pressure is structural, and stability is priceless. People around the world are not just watching markets anymore, they are reading signals. Signals of fragility, signals of transition, signals of change, signals of adaptation. And the message is clear. The future belongs to systems that are resilient, not fast. To assets that are stable, not flashy. To strategies that are defensive, not aggressive. To value that is real, not promised. Gold and silver are not symbols of fear. They are symbols of foresight. They are not assets of panic. They are assets of preparation. They are not instruments of chaos. They are instruments of balance. In every era of uncertainty, humanity returns to the same truth. Real value outlives every system. Real stability outlasts every policy. Real assets survive every crisis. This is not the end of the financial world. It is the evolution of it. And in that evolution, gold and silver are not just rising, they are reclaiming their role. Not as trends, not as trades, not as hype, but as foundations.